basically have the assets on one side, and we'll also have the excess capital. We'll have liabilities on the other side. But over and above that, you should be able to take care of all your liabilities. So for instance, if you're starting a business, you must ensure that your resources, your capital, your assets are always above your liabilities. So you need to take care of all the expected and unexpected losses. And the company will be required to have what we term as required purposes. So there is a relationship between risk and capital. The more risky you are as an institution or as a business, the more capital you will be required to have. So thereby you'll be able to see some companies do have more capital than others because the risk profile is bigger or is higher than what their business is entailing. So the greater the potential deviation from the expected business, the more capital you will be required to have. I'll basically go and jump into this particular component. So capital adequacy, we look at two things. We look at the regulatory capital requirements that will be set by the regulator or the business, by the regulator of a jurisdiction. So how much an insurance company needs. And we have what we call capital resources. And this is how much the insurer has. So the relationship between the capital resources and capital adequacy requirements basically leads to what we call capital adequacy ratios. Now, the capital resources of an insurance company will be divided into different tiers. There'll be tier 1, and these will be mostly the loss-absorbing capital elements. And we have tier 2, basically will be used for winding up. So it will be important for an insurance company to divide its capital resources into different tiers. And this will depend on the loss-absorbing capacity of that particular capital resource, the level of subordination. In this particular case, we are talking about if this particular capital belongs to that particular entity and how permanent those particular capital resources are. So it will be important for an institution to think about essentially having the capital resources into different tiers of business. So as per the requirement, you'll be able to see that mostly the first tier of capital will be highly permanent, that it will belong to the insurance entity. It will be subordinated to the policy holder of the business. It will be subordinated to the business, and also it will be free of mandatory charges. In this particular case, they will not be encumbered to any other person other than the insurance business. I'll jump into different solvency regimes. So there are different types of risk-based capital models. The one is highly related to risk factors, and the other one will be related to stochastic methods. That means that they'll basically be using a stress approach in terms of computing these particular capital resources. So looking at different jurisdictions in the world, we have the likes of US that use an risk-based capital calculation. Canada uses minimum capital triangulation calculation to dynamic capital adequacy terms. And if you basically zero into Africa, you'll get that jurisdictions such as Kenya uses risk-based capital computation to more other Solvency I regimes whereby other jurisdictions in Africa are basically using. So this risk-based capital model ideally looks at different types of risks. We start from the credit risk that will be highly related to maybe the risk arising out of counterparties, to market risk that will depend with the market, the price movements within the market. And also we are going to look at what we call the reserve risk, that will depend on how well the company has been valuing their liabilities, to the premium risk that will highly look at how well that the business has been pricing their products. So over and above that, these will bring the component of what will be the risk-based capital. So ideally also the company needs to look at what will be their operational risk when it comes to the computation. Most of the time a company needs to look at what will be the benefit, the diversification benefit based on how they're looking at those particular four risks. I won't basically deal with the issues on how the considerations that need to be done, because I'll be able to share these particular slides, but there are different components that needs to be looked at. And when we talk about components, those are the risks. We need to look at different risk measures, and these will be defined within these particular presentations, which I'll be able to share. So it is very important for all the risks to be addressed when we look at capital issues. We need to look at claim risks, claims reserve risk, premium risks. We need to look at things such as catastrophe risk, credit risk, market risk, and operational risk. And it will be important to ideally look at these particular risks at a very granular level. The key issues that you might need to look at is how then do these risks depend on each other? How then do you recognize those particular risks in the balance sheet, and how these particular risks are concentrated? Are concentrated in terms of the economic risk factors, the market sectors that you are dealing with, and the individual counterparties. Now, when it comes to development of these particular models, data availability will be of great importance. Now, there are different questions than you will be able to ask yourself. And ideally, the first question that most jurisdictions ask themselves is, what is the risk measure? What methods are we going to use? So a company or a jurisdiction might use a value at risk method to a tail value at risk method. Another question that an institution will need to ask itself is, what time horizon should we apply? Most of the time, most systems around the world are using 1 year time horizon. What is the level of risk should we undertake? And in this case is the level of calibration. Just some jurisdictions are using 99.5%, and some do use 99% tail value at risk. What risks should be included? We've mentioned a couple. Should be market risk, should it be credit risk, should it be insurance risk, and how then do we define these particular risks? What method are we going to use? Is it a standardized method? Is it an internal approach method? And how then are we going to aggregate these particular risks? These are some of the important questions that will be very important to use. Now, in summary, as we conclude, the issue is that we need to understand what is the capital, what is the purpose of capital. We need to look at what approaches are we going to use while determining regulatory capital requirement. We've talked about a standard approach to a stochastic approach. Some countries do use a mixed approach, both a risk factor method and stochastic. There are 5 risks that ideally we need to capture. We need to look at the risk profile of a company, because as the company risk profile increases, they need to increase their capital adequacy requirements. They need to look at the supervisors and how do they look at the risk characteristics. Now, I think we'll be running out of time. So after the end of this particular call, I'll send a new link whereby we'll have a discussion because I'm having a minute or so, basically taking you through this particular summary. But within the next link that I'm going to send to your emails, I'll be able to call in for questions and we'll be able to have a discussion. So I'll stop at this, and then in the next couple of, in 1 minute or so, I should be able to send you a link that will be able to join. So thank you, and we'll be meeting in the next 5 minutes using the new link. Thank you.